In Warren's words, Graham's book changed my life. He taught me how to think about stock and the stock market. Now, those are some powerful words from one of the richest investors in the world. If you want to start thinking like Warren Buffett and other great investors in the world, watch this video to the end. The first lesson from the book is to understand the difference between investing and speculating. Investing is buying a stock based on a careful analysis of its true value and long-term growth potential. It involves research, minimal risk, and a long-term time horizon. Speculating is buying a stock just because its price is rising or falling, or you've just heard people talking about it on social media or the news. It involves emotions and high level of risk, which is not backed by careful analysis and research of the underlying value of the company you're trying to buy. Graham recommends avoiding speculation altogether. Focus on finding great companies selling below their true wealth, buy them and hold them for the long run before you sell them to make good gain. Consider this: an investor who remained invested in the S&P 500 with $10,000 from Jan 2002 to the year 22 for 10 years will have made a 9.4% annualized return. The return would almost halve at 5.21% if he just missed the 10 best days of the S&P 500 during this time. And 7 out of those 10 best days happened within 2 weeks of the 10 worst days of S&P 500. A true investor who's bought stock based on careful analysis and research would remain invested in times of market volatility. A speculator, on the other hand, might get worried and start second-guessing his investment strategy and, worst case, sell stocks and lose out in the long run. The second lesson from the book is to always look for a margin of safety when buying a new stock. Margin of safety is when you can buy a stock for much cheaper than what it's really worth. It's like getting a designer handbag or watch on a massive discount. You know it's worth more than the price tag. Let's understand the definition of real worth or intrinsic value and market price of a stock. The real worth or intrinsic value of a stock is driven by its profitability, future growth potential, how visionary its products and leadership are, and how well it is placed against its competitors. It is the price that a smart investor would pay if they knew everything about the business's current performance and future potential.
Shut up and take my money!
Now, mind you, it's very hard to really find the real value of a business, but with good research, you can make a reasonably good estimate of what a stock's really worth. The market price of a stock, on the other hand, is the price people are willing to pay for the stock in the market right now. It is impacted by demand and supply, how many people are looking to buy and how many people are looking to sell. It is also impacted by macroeconomic factors such as inflation, and it may also be driven by factors which do not have any impact on the actual performance of the company and its future potential. Now that you understand the difference between the two, Graham says, bigger the bargain, lower the risk, and higher the potential for future profit and gains. Graham recommends that investors should buy for stocks that are trading at least half of their true worth. This means even if they're wrong in their analysis of the true worth of the stock, by buying it at a discount, the potential for losses becomes significantly lower. In 2010, Apple was trading at $10 a share. The true worth of Apple's share was much higher because of its innovative products, visionary leadership, and position against its competitors. If you'd bought 100 shares of Apple for $10, those shares would have been worth $19,300 in July 23. Now that is a gain of 18.3K. or about 18 times your original investment. And that is exactly what Graham means by buying stocks based on their true potential, and buying it at $10 at the time would have been a real bargain.
Oh my God! Wow!
So next time you go shopping for stocks, remember to look for bargains, buy low and sell high, and always have a margin of safety. Graham categorizes investors into two categories: defensive and enterprise investors. For the sake of simplicity, I will call a defensive investor as a steady Eddie investor and an enterprising investor as a go-getter. A steady Eddie investor wants to play it safe and minimize losses. They use simple diversified strategies like index funds or ETFs. They don't try to time the market or chase trends. They avoid high broker fees and aim for returns around 8% per annum. A go-getter investor, on the other hand, strives to beat the market and maximize their potential gains. They actively seek undervalued stocks, which have a high upside. Do lots of research and analysis to identify the really high value stock. They're prepared to handle uncertainty and volatility in the market. And they aim for average returns above 15% per annum. Graham suggests that most investors should be defensive rather than enterprise, because it requires much less time, effort, and skill. However, he acknowledges that some investors may have the ability, temperament, and potential to adopt the aggressive strategies and be enterprise investors. In lesson 4, Graham talks about emotions and psychology of dealing with Mr. Market, a fictional character representing the stock market. Mr. Market is extremely moody and bipolar. Some days, Mr. Market is super euphoric and excited, and he'll offer to buy your stocks at sky-high prices. Other days, Mr. Market is totally depressed about stocks. He'll offer to buy your stocks only at dirt cheap bargain prices. Mr. Market's mood changes all the time, growing from euphoric highs to depressed lows.
Mood swings! Mood swings. Mood swings. Mood swings. Mood swings. Mood swings!
But here's the key. You don't have to accept Mr. Market's emotional offers. You can ignore Mr. Market when he's irrational. Or you can seize the opportunity and buy stocks when he's depressed and they're selling at dirt cheap prices. From its pre-2007 financial crisis peak to its depressed low in 2009, the S&P 500 dropped by more than 50%. But the underlying businesses that made up the S&P 500 didn't necessarily had a decline of 50% in their business performance and the integrity or long-term growth potential. This massive decline in many cases was driven by panic and emotions. Mr. Market was in an extremely depressed mood. Of course, the S&P 500 index then went on to triple over the next decade, when Mr. Market's mood entirely changed and he became very optimistic about the market. There is a famous saying from Warren Buffett: be fearful when others are greedy, and be greedy when others are fearful. Inflation is the general increase in prices over time, and it reduces the purchasing power of money. For example, if you invest $1,000 or pounds in a stock which grows for 5% over the next 10 years, the stock would be worth more than $1,600 at maturity. However, if there was inflation of 3% over the same period, your stock would only be worth $1,218. Graham suggests that investors should protect themselves from inflation by diversifying their portfolio into different asset classes, such as real estate, gold, and stock. Graham also recommends that investors should buy stocks which have a strong earning growth, high dividend yields, and low debt ratio. Dividends are basically profits shared by companies with their shareholders. Graham makes various compelling arguments in the book about why investors should really appreciate and value having dividend stocks in their portfolio. Dividends represent steady income which can be either reinvested or spent. Dividend payouts signal strong health of a company. Only businesses which have confidence in their ability to generate cash flows pay dividends to their shareholders. Graham advises that investors should look for companies which pay dividends which keep growing each year. The stock market in many cases represents herd mentality. When everyone is buying a stock, it's usually a good time to sell. And when everyone is selling a stock, it's usually a good time to buy. Don't be afraid to go against the crowd and make your own investing decisions. The herd mentality can be dangerous because it can lead to buying high and selling low. A very good example of herd mentality is COVID-19. The S&P 500 fell by more than 30% within 2 weeks. The fear and second guessing of investing strategy by speculators led to a huge sell-off in the market. The decline was temporary. Within the next 6 months, the S&P 500 rebounded more than 50%. As the investors realized the pandemic was not as bad as they thought. When picking stocks, fundamental analysis should be your guiding light, just like North Star is for the sailors. Performing fundamental analysis of a company involves scrutinizing its financial statements. Financial statements include the balance sheet of a company, which shows How many assets and liabilities does the company have at a point in time? Looking at company's income statement, which shows the revenue, costs, and profits generated by the business. The third statement is the cash flow statement, which shows the cash generated and utilized by the business over a period of time. Reviewing these three financial statements gives you a very good indicator of the business's current financial performance. You should also look at the management team of the company. You can get a lot of this information just by attending investor relation calls where the leadership of the business provide details of their plans on how they are going to grow the business over time.
And in addition, Pewterschmidt Industries' pharmaceutical division is up over 30%. Profits in new media have doubled each quarter over the past year, and our stock is at an all-time high.
All right, stand aside. I'll take it from here.
Look at the competitive landscape of the business. Who are the rivals? What are the threats and opportunities to the business in the short and long term? This highlights risk and growth potential. Use fundamental analysis as your North Star for steady investing success. Thank you for watching and making it to the end of the video. I hope you enjoyed it and learned something new. If you did, smash that thumbs up button and subscribe to my channel for more content. Which lesson or strategy laid out by Graham really resonated with you? Let me know in the comments section. Don't forget to hit the bell icon to stay notified of my next videos. I post a new video every second, third, and fourth Sunday of the month.